Okay, and finally in chapter 12, we are looking at pretty much everything we've learned and applying that to making business decisions and looking at the relative costs in those decisions. So we're going to distinguish between relevant and irrelevant costs in decision making. We're going to prepare analyses for various situations, such as discontinuing a product line, whether to sell as is or process further. I think we also look at whether we should make or buy a component, accept a special order, and how we should best apply constrained resources. So we're going to determine the most profitable use of a constrained resource and the value of obtaining more of that constrained resource. And we omit all of the appendixes and we are sticking with just the decision-making situations. So we start the discussion by looking at what is a relevant and what is an irrelevant cost. So a relevant cost is a cost that differs between two different alternatives. An avoidable cost is one that can be eliminated in whole or in part by choosing one alternative over another. All avoidable costs are relevant costs. Any costs that are unavoidable are irrelevant. So there's two broad categories of costs that are never relevant in any decision, and those are sunk costs, as well as future costs that do not differ between alternatives. So the real focus of this is, can we reduce costs or increase revenues by choosing between two different alternatives? So to identify the costs and benefits that are relevant in a particular decision situation, we follow a specific set of steps. We eliminate costs and benefits that do not differ between alternatives. So if they stay the same between option 1 and option 2, then we don't worry about them. They are not part of the decision-making process. We use the remaining costs and benefits that differ between alternatives in making the decision. The costs that remain are those that are differential or avoidable costs. Costs that are relevant in one decision situation may not be relevant in another context, so each individual situation needs to be analyzed separately. So for example, Sarah, a Toronto student, is considering visiting her friend in Windsor. She can drive or take the train. By car, it is 230 kilometers to her friend's apartment. She is trying to decide which alternative is less expensive and has gathered the following information. So automobile costs based on 10,000 miles driven per year. Annual straight line depreciation on the car is $2,800, which was calculated by taking 18,000 cost minus 4,000 salvage value and dividing by 5. This breaks down to 0.280 cost per mile. The cost of gasoline is 0.05 per mile. The annual cost of auto insurance and license is $1,380 or 0.138. Maintenance and repairs, 0.065. Parking fees at school are $360 a year or 0.036 per mile. All of this bringing down to a total average cost of 0.569 per mile. So the first thing we do is identify our relevant costs versus the irrelevant costs. So we're given some additional information as well. We have reduction in resale value of the car per kilometer of wear, the round trip train fare, benefits of relaxing on a train trip, which we can't assign a dollar value to, the cost of putting the dog in the kennel while gone, the benefit of having a car in Windsor, the hassle of parking a car in Windsor, and the per day cost of parking the car in Windsor. So which costs and benefits are relevant in Sarah's decision? The cost of the car itself is a sunk cost and is not relevant to the current decision. A sunk cost refers to one that no matter what we do, we can't get that money back. So she already bought the car. Whether she drives it to Windsor or she takes the train to Windsor, the cost of the car itself is a sunk cost that she's not going to get back. The annual cost of insurance is also not relevant. It remains the same if she drives or takes the train, so it does not change between the two alternatives. However, the cost of gasoline is clearly relevant if she decides to drive. If she takes the train, the cost would now be incurred, so it varies depending on the situation. The cost of maintenance and repairs is relevant. In the long run, these costs depend upon miles driven. So if she's driving more miles to go to Windsor, she's going to put more wear and tear on the car, which might increase the cost of maintenance and repairs. The monthly school parking fee is not relevant because it must be paid if Sarah drives or takes the train to Windsor. It's not a part of this specific decision. So at this point, we can see that some of the average cost of 0.569 per kilometer are relevant and others are not. So one thing to note here is we are in Canada. We do use kilometers. The fact that it broke it down on a per mile basis, I think, is a typo since they're now stating that actually is per kilometer and not per mile. But using the two different bases, of course, would yield different results. So continuing the discussion, the decline in resale value due to additional miles is a relevant cost, right? If she decided to sell the car tomorrow, if it had less miles on it, then she might be able to demand a slightly higher price. The round trip train fare is relevant. If she drives, that cost can be avoided, so it differs between the two alternatives. Relaxing on the train is relevant, even though it is difficult to assign a dollar value to that benefit. The kennel cost is not relevant because Sarah will incur the cost if she drives or takes the train. Either way, the dog's not going with her. So when that cost does not change between alternatives, then it is not relevant to our discussion. The cost of parking is relevant because it can be avoided if she takes the train, but the benefits of having a car in Windsor and the problems of finding a parking space are both relevant, but are difficult to assign a dollar amount. So from a financial standpoint, Sarah would be better off taking the train to visit her friend based on the incremental analysis that arrives from our relevant factors. Some of the non-financial factors may influence the final decision. So the relevant financial cost of driving is the gasoline, the maintenance, the reduction in resale, and parking in Waterloo for a total of 114 versus the cost of taking the train, which is 104. So now we are going to look at total and differential cost approaches, and we're going to demonstrate this through an example. The management of a company is considering a new labor-saving machine that rents for $3,000 per year. Data about the company's annual sales and costs with and without the new machine are broken down below. So usually in this approach, which is often called an incremental analysis, we look at our current situation and then we look at data for the alternative situation. So in this case, the situation with the new machine. And then we look at the incremental difference between the two alternatives. So for example, sales will remain at 5,000 units at $40 per unit under both the current and the situation with the new machine. So there's no difference. Those costs don't change depending on the alternative, so it's not relevant to the discussion. If getting this new machine was going to increase production and as a result increase sales, then we would look at the difference. Next, we look at our variable expenses. The direct materials, again, remains the same between the two alternatives, so it is not relevant. Our direct labor, however, is 40,000 in our current situation and is going to drop to 25,000, which gives us a difference of 15,000. And that is a difference in cost savings that would increase our operating income. Our variable overhead remains the same. Our contribution margin, because of those lowered labor costs, is going to be slightly higher under the new situation. So we see that $15,000 difference. Next, we're looking at our fixed expenses. Our other fixed expenses doesn't change, so that remains the same. We would have an additional $3,000 cost associated with the new machine. So that is shown as a negative amount because that is an additional expense that would have the effect of reducing our operating income. So when we look at that change in contribution margin of $15,000 and we deduct the rent on the new machine, we get an overall increase to operating income of $12,000. So we can efficiently analyze the decision by looking at the different costs and revenues and arrive at the same solution. So that's what we just did. Okay, we looked at the decrease in our direct labor costs versus the increase in our fixed rental expenses, seeing that net annual cost savings of $12,000. So using the differential approach is desirable for two reasons. One, only rarely will enough information be available to prepare a detailed income statement for both alternatives. Two, mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is actually really critical or crucial to the decision being made. So one of the most important decisions managers make is whether to add or drop a business segment, such as a product or a store. So it's not always a clear-cut case that if a product line is losing money, we should drop it. And we're going to see that as we go through the discussion. There are times that even though a specific product line is not profitable, it still is better for the business overall to keep that product line. So we're going to explore how relevant costs should be used in this type of decision. Due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years, and they're considering discontinuing that product. So Lovell should drop the digital watch segment only if its profit would increase. This would only happen if the fixed cost savings exceed the lost contribution margin. So looking at the segment income statement for digital watches, we have sales of $500,000. We have variable expenses of $200,000, giving a contribution margin of $300,000. So even though that segment is not profitable, it does contribute $300,000 for the business to cover fixed expenses and help to earn a profit. After looking at the contribution margin, when we deduct our fixed expenses that are relevant, we see that we have a net operating loss of $100,000. So investigation has revealed that the total fixed general factory overhead and general administrative expenses would not be affected if the digital watch line is dropped. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. The equipment used to manufacture digital sales has no resale value or alternative use. So should they retain or drop this segment? Oops. So we're using the contribution margin approach by looking at the amount of contribution margin that would be lost if we were to drop this line. So overall, $300,000 would be lost. We're going to deduct from that any fixed costs that can be avoided. Because remember, there was some of the fixed costs that would not be changed, and we would end up just reassigning those to other areas. So we can avoid the salary of the line manager. We can avoid direct advertising as well as rent on the factory space for a total of $260,000, leaving a net disadvantage of $40,000. So the Lovell solution can also be obtained by preparing comparative income statements showing results with and without the digital watch segment. So let's look at what that would look like. So if the digital watch line is dropped, the company gives up its contribution margin of $300,000, and we saw that through the contribution margin approach. On the other hand, the general factory overhead would be the same, so that cost isn't relevant because it doesn't change between the two alternatives. But we wouldn't need a manager for the product line anymore, so we would save on those costs. We would, if the digital watch line is dropped, the net book value of the equipment would be written off. The depreciation that would have been taken will flow through the income statement as a loss instead. And we saw that we got rid of the advertising as well as the rent on the factory space, but that our general administrative expenses would remain the same. So if we keep the digital watches, our net operating loss is $100,000. If we drop the digital watches, our net operating loss is actually $140,000. So getting rid of this product line actually reduces our net operating income by a further $40,000. So why should we keep the digital watch segment when it's showing a $100,000 loss? The answer lies in the way that we allocate common fixed costs to our products. Our allocations can make a segment look less profitable than it really is. So when a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. So what we're looking at here is if we have a specific component to a product that we can make in-house, or we can buy that component from another supplier. The advantages are that smoother flow of parts and materials, there's better quality control, and we may realize profits if we make it in-house. Disadvantages are that companies may fail to take advantage of suppliers who can create economies of scale advantage by pooling demand from numerous companies. So Essex Company manufactures part 4A that is used in one of its products. The unit product cost of producing that amounts to $30 in total, which is comprised of our direct materials, direct labor, our variable overhead, depreciation of special equipment, the supervisor's salary, and our general factory overhead. The special equipment used to manufacture part 4A has no resale value, and we make an assumption that it can't be reassigned to something else. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. The $30 unit product cost is based on 20,000 parts produced each year, and an outside supplier has offered to provide the 20,000 parts at a cost of $25 per part. So the question we're asking is, should we accept the supplier's offer? On the surface, it looks like yes, right? It's costing us $30 to produce. We can get it for $25. We're saving $5 per part. So we should accept the offer. But when we look at the decision on what are relevant versus irrelevant costs, we may come up with a different solution. So the outside purchase price is $25. So if we were buying 20,000 units, that's going to cost us $500,000. We can avoid the direct materials, the direct labor, and the variable overhead, as well as the supervisor's salary. So the cost to make is going to be $340,000. The cost to buy is going to be $500,000. So we're also assuming this special equipment has no resale value, and so it is a sunk cost. If we were able to sell that machine or to reassign it to something else, then that is a relevant cost that we would have to look at. But because we can't do either of those things, it is a sunk cost. And the general factory overhead is not avoidable, so it is irrelevant to the conversation. If the product is dropped, it's simply reallocated to other products. Oops. So this is just, again, what we just looked at. I'm not sure why they included it twice. So when we talk about these types of things, an opportunity cost is the benefit that is foregone as a result of pursuing some course of action. The opportunity costs are not actual dollar outlays and are not recorded in the formal accounts of an organization. So how would this concept potentially relate to the company that we're looking at? So they're leaving a lot of holes in this particular PowerPoint. So opportunity costs that we could look at would be that the capacity that we currently use to produce product 4A, if we could reassign that to producing something else or to increasing our output, that is an opportunity cost that we need to include as part of our analysis. Okay. If we can't reassign or there's no potential to earn any additional profits by reassigning, then it is not relevant to the conversation. Another decision that we make is whether or not to accept a special order. So a special order is a one-time order that is not considered part of the company's normal ongoing business. So for example, if somebody contacted us and said they want to purchase 2,000 units of our product, but at a reduced price or less than what we would typically sell it as, that would be considered a special order. Excuse me. When analyzing a special order, only the incremental costs and benefits are relevant, like we've seen in all of our other decision making. So for example, Jet Inc. makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units at a cost of $10 per unit. This is a one-time order that would not affect the company's regular business, so that's an important statement. If we don't have any excess capacity, then we would have to take capacity from our regular business operations in order to produce these 3,000 units. Okay? Annual capacity is 10,000 units, but Jet Inc. is currently producing and selling only 5,000 units. So that means that they do have excess capacity available in order to produce those additional 5,000 units. So looking at this, our revenues are currently 5,000 units at $20 each, which is 100,000. We have a breakdown of our variable costs to get to our contribution margin. Deducting our fixed costs, we have a net operating income of 12,000. So if Jet accepts the special order, the incremental revenue will exceed the incremental costs. In other words, net operating income will increase by 6,000. So this suggests that they should accept the offer. So our increase in revenues will be 3,000 units at $10 each. We have an increase in costs for the variable costs. Our fixed costs are not going to change because our relevant range is up to 10,000 units. So we're only producing 5. An additional 3 puts us to 8,000, which is still within the relevant range. That means we don't have to pay overtime, we don't have an interruption to our regular production, okay, all of those things. So our increase in revenue minus our increase in costs leaves us with an increase to net operating income. So this answer assumes that fixed costs are unavoidable and that variable marketing costs must be incurred on the special order. But that might not actually be the case, which would be a relevant part of the decision making if we had that data available. So one other thing to consider in terms of whether or not they should accept the order is that there is some qualitative factors as well. Okay? Are we going to anger some of our regular customers by accepting the special order at a lower price, which might result in the loss of some of our regular business? Okay, we've made the assumption that it won't interrupt our regular business, but that potential does exist and is something that should be considered when making a decision like this. So another decision scenario that we look at is joint product costs. In some industries, a number of end products are produced from a single raw material input. 2 or more products produced from a common input are called joint products. So think about example, milk and cream. Okay, they all come from the same raw milk source, but they are 2 products created from that one raw material. Another example is the production of oil and gasoline products. All come from one raw material, and then how it is refined, it tells us the end product. The point of the manufacturing process where each joint product can be recognized as a separate product is called the split-off point. So for example, we have our joint input, we have a common production process, and at the split-off point, then we have oil, gasoline, and then chemicals. Okay, so the raw material undergoes a common production process up to the split-off point. And then there's going to be additional processing costs for each of the individual products after that split-off point. So the oil gets separate processing before final sale. Gasoline goes straight to final sale. There's nothing else that needs done with it. and the chemicals require separate processing before final sale. So those separate processing costs are separate product costs depending on the product that we're looking at. Another example that they provide is wool. Okay, so all the raw wool is gathered after the sheep have been sheared. It goes through a separation process that results in three separate outputs. We have on-dyed coarse wool, we have on-dyed fine wool, and we have on-dyed superfine wool. From each of those three products, we can process them further by dyeing and refining that product to get to our dyed coarse wool, our dyed fine wool, or our dyed superfine wool. So the decision that we need to make is, do we sell at the split off point or do we process further? For example, our on-dyed coarse wool has a sales value at that point of $120,000. Additional processing means that we can sell the final product for $160,000. Okay, but we have an additional cost of $50,000 in the dyeing process. Our on-dyed fine wool can be sold for $150,000, or we can dye it further at a cost of $60,000 and sell for $240,000. So we need to look at each product after the split off point to decide whether it is worth undergoing that further processing and incurring those further costs to sell the final product. So joint costs are often allocated to end products on the basis of the relative sales value of each product or on some other basis. Although allocations is needed for some purposes, such as balance sheet inventory valuation, allocations of this kind are very dangerous for decision making. Okay? And that's because those joint costs that occur before the split off point are going to be considered a sunk cost. To get to our three intermediary products, we need to incur those joint costs. Okay, even if we decide to process further after that point, we still have to incur those initial costs. So joint costs are irrelevant in decisions regarding what to do with a product from the split off point forward. It will always be profitable to continue processing a joint product after the split off point, so long as the incremental revenue exceeds the incremental processing costs that are incurred after the split off point. For example, Sawmill Inc. cuts logs from which unfinished lumber and sawdust are the immediate joint products. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can also be sold as is to gardening wholesalers or processed further into Presto logs. Our data about Sawmill's joint products include the sales value at the split off point is $140 per log for the lumber and $40 for the sawdust. The sales after processing further amount to $270 per log for lumber and $50 for sawdust. Allocated joint product costs are $176 and $24, and the cost of processing further are $50 and $20 respectively. So we're going to first look at, the incremental analysis of the decision on whether to sell or process further. So for the lumber, our sales value after processing further is $270. Our sales value at the split off point is $140, giving an incremental revenue or an increase in revenues of $130. The cost of processing further is $50, and the profit amounts to $80 from further processing. For the sawdust, however, our sales value after processing is $50, but it already has a sales value of $40 at the split off point, which increases our revenue only by $10. It costs $20 to process further, which means we would incur a $10 loss for processing further. So looking at this, we can see that the lumber should be processed further, but the sawdust should be sold as is. So one other thing I'll mention here is that we did omit, the allocated joint product costs because they are irrelevant to the decision. Okay, those are incurred either way because they incur before the split off point. So we may also come across a situation where we have a constrained resource. When a limited resource of some type restricts the company's ability to satisfy demand, the company is said to have a constraint. The theory of constraints maintains that effectively managing a constraint is important to the financial success of an organization. So the challenge is deciding how to best utilize the constrained resource to maximize the company's profits. When a constraint exists, a company should select a product mix that maximizes the total contribution margin earned, since fixed costs usually remain unchanged. A company should not necessarily promote those products that have the highest unit contribution margin. It all depends on the mix and the constrained resource. Rather, it should promote those products that earn the highest contribution margin in relation to the constrained resource. So looking at an example, we have Ensign Company who produces 2 products, and the selected data are shown below. Our selling price of product 1 is $60, less our variable expenses gives us a contribution margin of $24 per unit. Product 2 has a $50 selling price. Our variable expenses are $35, giving us a contribution margin per unit of $15. Product 1 demands 2,000 units per week, and product 2 demands 2,200 units per week. Our contribution margin ratio is 40% for product 1, 30% for product 2, and the processing time required on machine A1 per unit is 1 minute for product 1 and half a minute for product 2. So machine A1 is the constrained resource. It is being used at 100% of its capacity. There is excess capacity on all other machines. Machine A1 has a capacity of 2,400 minutes per week. So should we focus our efforts on product 1 or product 2? So the key is the contribution margin per unit of the constrained resource. So this is not contribution margin per unit on its own. It's contribution margin per unit as it relates to the use of machine A1. The contribution margin per unit on product 1 was $24, but it takes 1 minute to produce each unit. So our contribution margin per minute, 24 divided by 1, is 24. Product 2 had a contribution margin per unit of $15, but it takes half the time. So when we divide 15 by 0.50, we get a contribution margin per minute of $30. So product 2 should be emphasized because it provides more valuable use of the constrained resource machine A1, yielding a contribution margin of $30 per minute as opposed to $24 per minute for product 1. If there are no other considerations, the best plan would be to produce to meet current demand for product 2 and then use any remaining capacity to make product 1. So let's look at how this plan would actually work out. So the weekly demand for product 2 is 2,200 units. At half a minute, it would take 1,100 minutes to produce. We have total time available of 2,400 minutes. So we deduct the time it took to make product 2, which leaves 1,300 minutes available for product 1. The time required per unit for product 1 is 1 minute, which means that with the excess time, we can produce 1,300 units of product 1. So according to the plan, we'll produce 2,200 units of product 2 and then 1,300 units of product 1, and our contribution margins are shown on the screen. So for product 1, 1,300 units we're assuming that we are going to be selling all of those units based on demand. Our contribution margin per unit is $24, giving us a total contribution margin of $31,200. Product 2, again, we make the same assumptions. We get a total contribution margin of $33,000, which means the total contribution margin for this company for both products is $64,200. So there is a lot of just relevant factors that goes into managing these constraints. So profits can be increased by effectively managing constraints, and we saw that in the previous example. One aspect of managing constraints is to decide how best to utilize them. So managers should focus on managing any bottlenecks and find ways to increase the capacity at those bottlenecks, which can be accomplished in a number of ways. By improving the process, by adding overtime or another shift, by hiring new workers or acquiring more machines, by subcontracting production, by reducing the amount of defective units produced by increasing quality standards, or by adding workers transferred from non-bottleneck departments into the area where the bottleneck is occurring. So a bottleneck refers to, in the production process, where production is basically slowed because that specific area can only produce so many units or process so many units at a specific rate. So the problem comes that a firm often has more than one potential constraint. So how do we find the right combination of products to produce when we're dealing with multiple constrained resources? The right combination of products or the mix of products can be found using a quantitative method called linear programming. So we're not going to go into what linear programming is. It's outside of the scope of this particular course. The takeaway here is looking at the contribution margin per unit of the constrained resource, not just a contribution margin per unit of the product. So that brings us to the end of the chapter with the exception of the appendices, which we're not going to go into. So we looked at relevant costs and benefits are those that will be incurred in the future and that differ among the alternatives under consideration. Sunk costs are irrelevant because they are incurred in the past and nothing we do can change those. Any avoidable, differential, or opportunity costs are all relevant because they differ between our alternatives. Different decision situations often faced by managers include adding or dropping a product line or segment, making versus buying decisions, accepting or rejecting special orders, and selling versus processing joint products further. Another common decision-making scenario that uses incremental analysis is also whether or not we should replace or retain some aging equipment. This edition of the textbook doesn't go into that, but be aware that that is also a decision that uses the same type of incremental analysis, looking at our relevant costs between the two alternatives. So that brings us to the end of the PowerPoint and wrapping up this first video. There will be probably another 2 videos that go over the in-class assignment where we look at actually walking through some of these decisions.